Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth, and today, fitting that we're going to end the year talking about the Federal Reserve. We started the year talking about the Federal Reserve and kind of have really talked about them all year long. The market has beat to their drum. As I said in the very beginning of the year, we were going to. And so the Fed met yesterday. Today's Thursday. Yesterday was Wednesday. They had their meeting and came out and raised interest rates, the federal rate by 50 basis points, 0.5%. And so I wanted to go over that, go over a few things that Powell said, and maybe what the beginning of next year may look like in rate hikes. So let's dig in. Hope this will help. So I wanted to start off with a statement that Powell made, and it goes like this. I wish there was a painless way to restore price stability, but there is not. There is not. So we knew this. We knew going in that getting rates back to where they should be, getting a normalized rate environment was going to be painful to get there. But we're getting very, very close, and we've had a pretty volatile year in the market. But hopefully starting next year that we can kind of get back to normal. Let's look at this year's hike. So started in March, 17th of March, with a 1/4 point hike, then quickly moved into May with a 0.5 point, and then they really bumped it up with a 0.75% for 4 straight meetings, and ending the year on a 0.5% increase. Now, we're kind of at the highest Fed funds rate that we've seen in many, many years. Once again, that is for them they're trying to tame the market and get inflation in check. So kind of on par yesterday with what the market was thinking it would be. And then, we're just continue to look at data of how inflation is going to, kind of tail off here? And are these rate hikes really starting to affect inflation like they hoped it would? So we're hoping that's the case. But once again, inflation's a weird animal, and sometimes it's not a simple 1 + 1 = 2. So let's look at 2023. So a couple of economists came out, and they're looking at 25 basis points at each of the first 2 meetings in 2023, reach a target range of about 4.75 to 5, and that's before the Fed maybe take a pause. So, I think that's kind of on target with what the market is hoping. I think if this comes to fruition, we should see the market react very, very favorable. When the Fed decides that they're no longer raising interest rates, you're going to see this market, really come back and hopefully come back really strong. So the market's really looking for stability, and the day the Fed comes out and says we are now kind of where we think we should be, we don't see any more interest rate hikes in the near future. And they're probably always going to say, assuming inflation stays in check, I think you're going to see the market really respond, pretty favorable to that. So, as we move into 2023, I look for hopefully some stability in rate hikes, and maybe that tails off and the market can kind of get its footing and move forward from there. But other things are kind of creeping in with corporate profits, GDP next year. How strong will that be? How weak will it be? And we'll continue to monitor that as we move forward. So hope this helped. Y'all take care. God bless. We'll see you next week. Bye-bye.